This chapter 4 summarizes the changes currently under consideration by the Basel authorities, sometimes loosely referred to as Basel III, which have resulted principally from the 2008-2009 financial crisis. As a result of the financial crisis of 2008-2009, the Basel Committee issued a new consultative document in December 2009, which summarizes the key changes and additions it is contemplating at present. These can be downloaded at this link here and are summarized in this chapter. Broadly speaking, the proposed changes include the following. They emphasize common equity as the principal component of Tier 1 capital. They enhance the capital requirements for counterparty credit risk. They introduce a leverage ratio requirement that is not risk-weighted, i.e. that takes all exposures at face value, irrespective of inherent risk they contain. And they attempt to address the so-called pro-cyclicality problem, to be discussed in a moment, by requiring capital buffers over and above the minimum requirements to ease the pressure on banks to raise capital in the middle of a crisis when market conditions make this impossible or very expensive. With regard to the definition of Tier 1 capital, the consultative document clarifies the criteria an instrument must satisfy for inclusion in Tier 1 capital, emphasizing in particular that the instrument must be subordinated, must have fully discretionary, non-cumulative coupons or dividends, and must have neither a maturity date nor contain an incentive to redeem, such as a step-up in its coupon or dividend if it is not redeemed by a certain date. Further, any call option the issuing bank has on a Tier 1 instrument must be structured to ensure that the issuer would not exercise it unless it is in its clear economic interest to do so. Furthermore, the consultative document splits Tier 1 capital into common equity, viewed as the most reliable and loss-absorbing type of capital, and what is called additional going concern capital. To qualify as common stock, an instrument must meet 14 criteria enumerated in the document, the most important of which include: 1. That it must be the most subordinated claim in liquidation, and also must be entitled to all residual assets in liquidation in proportion to its share of issued capital after all senior claims have been repaid. 2. That it must be truly perpetual and not subject to an obligation, legal or otherwise, to be repurchased under predefined conditions. 3. Distributions, i.e. dividends, must not be tied or linked to the price at which the instrument was originally issued, nor subject to a cap, nor obligatory in any way, so that non-payment of dividends cannot constitute an event of default under the documentation. And 4, it cannot be guaranteed or secured, nor subject to any other arrangement that legally or economically enhances the seniority of the claim. The other category within Tier 1, additional going concern capital, is similarly subject to 14 non-identical criteria, the most important of which are the following. 1. It must be subordinated to depositors, general creditors, and subordinated debt of the bank. 2. It may be callable only after a minimum of 5 years, and then only if it is replaced with capital of the same or better quality. 3. Like common stock, it must not be secured or guaranteed, and must have no maturity date or incentive to redeem. 4. It cannot have a credit-sensitive dividend feature, i.e., which causes the dividend to reset periodically based to any extent on the bank's credit standing. And 5, very importantly, it must feature explicit loss absorption of principal through either conversion into common shares at an objective pre-specified trigger point, such as a reduction in capital ratios or in credit rating below a certain point, or a write-down mechanism which allocates losses to the instrument at a pre-specified trigger point and reduces the instrument's claim in liquidation or upon a later exercise of any call option. A few minor amendments are also proposed to the definition of Tier 2 instruments, but we will not explore these here. Turning to counterparty credit risk. The consultative document identifies a large number of deficiencies observed during the crisis in the management of this risk, particularly with regard to the computation of the expected exposure under derivative instruments during periods of market stress, the failure of most firms to set an adequate credit valuation adjustment, or CVA, for counterparty credit risk, the high correlation that became evident during the crisis among large financial institutions that are dominant players in the derivatives markets. Very importantly, the inability of most participants to recognize and guard against so-called wrong way exposure, which refers to cases in which the size of a bank's exposure to a counterparty is positively correlated to the default probability of that counterparty. An excellent example of wrong way risk at its worst involves the purchase of puts from companies against their own common stock. If this put goes deep in the money, the large drop in the stock price would presumably be indicative of a significant deterioration in the company's creditworthiness, making it less likely that the company will be able to honor this put if and when exercised. Indeed, in the most extreme scenario of the put reaching its maximum intrinsic value, which of course happens when the shares trade at zero, the company is certain to be bankrupt, and the put loses almost all value in the hands of the holder. Continuing with our list, the unexpected delays in closing out positions with significant counterparties upon default, especially when the underlying trades were particularly complex or had illiquid collateral. The destabilizing effect of margin calls that were triggered when a counterparty's credit rating dropped below a specified level, aggravating the financial condition of that counterparty and the liquidity stress it was experiencing. The failure to clear a vast percentage of trades through central clearing counterparties, or CCPs, a term to which we will return shortly. The use of securitized collateral whose price volatility proved far worse than that of comparably rated sovereign or corporate collateral. And finally, the inadequacy of most stress testing and backtesting methodologies. The consultative document therefore proposes new measures to deal with each of these problems. 1. A requirement that expected exposure metrics be calculated based on data that includes a period of stress. 2. A capital add-on that better captures CVA risk. 3. An explicit capital charge for specific wrong-way risk. 4. A 25% increase in the asset value correlation used for exposures to large, regulated financial institutions and to unregulated financial institutions. 5. An extension of the deemed period of risk between margin calls for counterparties with whom a very large number of trades is outstanding or whose collateral is illiquid. 6. A limitation on the capital benefits a bank may achieve on account of margin calls triggered by a counterparty credit rating downgrade. 7. A haircut on the value of collateral in the form of securitized instruments, and a complete prohibition on the use of such collateral for regulatory purposes in the form of re-securitizations, such as CDO squared instruments and the like. Next, incentives to use CCPs for clearing OTC derivatives by setting at zero the capital charge for exposure to CCPs that meet a number of specified conditions. And lastly, an enhancement in counterparty credit risk management requirements by making more explicit the qualitative requirements for stress testing and backtesting, and by revising model validation standards. The consultative document addresses next the perception that the banking system proved to be excessively leveraged at the outset of the crisis, and that the need to deleverage rapidly once the crisis had begun only exacerbated the collapse in asset prices and hence in capital ratios for most banks. The document therefore proposes a maximum leverage ratio test, calculated without adjustment for the risk weight of individual positions, and that would be additional to the risk-based tests we saw in earlier chapters. The maximum permissible leverage ratio has not yet been specified, but the following elements are listed in the document as likely to play an important role in the calculation of this leverage ratio. 1. The measure of capital will be a high-quality definition that reflects some of the restrictions we discussed at the beginning of this chapter. 2. Physical or financial collateral, guarantees, or purchased credit protection will not be allowed to reduce on-balance sheet exposures. 3. Netting in most forms will not be allowed, so that gross exposure measures will appear in the calculation of aggregate exposures. 4. Certain off-balance sheet items, including guarantees and written credit protection, will be included in aggregate exposure using a 100% credit conversion factor. 5. Securitizations, repos, reverse repos, and securities lending transactions will follow their accounting treatment. And finally, 6. Detailed disclosure will be required that sets out the calculation of the leverage ratio. The consultative document addresses finally the problem of procyclicality. A simple illustration of what is meant by procyclicality is provided first. When the economy slows down, credit losses in lending portfolios increase, damaging banks' profits and retained earnings, and hence their capital ratios. And credit ratings for many performing borrowers diminish, raising their risk weights under Basel II and reducing further lenders' capital ratios. Banks' ability to provide loans therefore diminishes at precisely the moment when borrowers are in need of increased lending to tide them over their current liquidity problems in anticipation of an economic recovery. In turn, this only exacerbates the economic downturn. The document addresses procyclicality by reinforcing the current rules that require banks to use long-term data horizons to estimate probabilities of default, and also to use downturn loss given default estimates rather than long-term averages, since recoveries on defaulted debt are typically lower than average when default rates increase above the norm. The document also proposes 3 principal changes to the current regime to diminish procyclicality. 1. Loan loss reserves should be set to reflect expected credit losses over the life of loan portfolios, rather than the current incurred loss approach, a change that has been proposed already by the accounting authorities and is supported by the Basel Committee. 2. Banks will be required to build up a capital buffer outside periods of stress of a size that is not yet specified in the document, to be drawn as losses are incurred. In particular, as banks approach the minimum capital requirements set under the rules, they should retain a greater share of earnings rather than distributing them to shareholders, according to the following proposed matrix that relates the percentage of earnings banks should retain to the amount by which the bank's capital currently exceeds the minimum requirement in percentage terms. Lastly, the consultative document discusses a proposal, still at an early stage of formulation, which would adjust the capital buffer range when there are signs that credit in the banking system has grown to excessive levels. This would involve the identification of a macroeconomic variable or group of variables to assess the extent to which, in any given jurisdiction, there was a significant risk that credit has grown to excessive levels. An example being the difference between the aggregate credit to GDP ratio and its long-term trend. These would take into account the variations in the stages of development of financial sectors across jurisdictions, and their breach of predefined thresholds would be used by national regulators to expand the size of the capital conservation buffer described just a minute ago. This completes this chapter 4 and brings us to the quiz.